So, good afternoon, everyone. Our lesson for today is all about bad debts expense. So, first, let us know what is bad debts expense. So, bad debts expense is the way businesses account for a receivable account that will not be paid. Bad debt arises when a customer either cannot pay because of financial difficulties or chooses not to pay due to a disagreement over the product or service they were sold. So, bad debts expense is the cost associated with uncollectible accounts. In the view of the company, it represents a loss to the company. So, there are two methods in reporting the bad debts on the financial statement. These are the direct write-off method and the allowance method. So, first, let us discuss what is direct write-off method. So direct write-off method involves writing off bad debts expense directly against the corresponding receivable account. So therefore, under the direct write-off method, a specific amount from a customer account will be written off as a bad debt. So under this method, bad debts are recorded when they are determined to be uncollectible. So to further understand what is direct write-off method, we have here an example. So for example, ABC Corp has a customer XYZ Enterprises who owes 1,000 pesos. The company decides that XYZ Enterprises will not be able to pay the debt. So um, the amount is written off directly to bad debts expense because XYZ Enterprises will not be able to pay the debt. So the journal entry here is first debit the bad debts expense for 1,000 pesos and credit the accounts receivable for 1,000 pesos. So the next method is the allowance method. So the allowance method estimates bad debts expense at the end of the fiscal year, setting up a reserve account called allowance for doubtful accounts, similar to its name. So the allowance for doubtful accounts reports a prediction of receivables that are doubtful to be paid. So compared to the write-off method, no, um, there if in the direct write-off method, debts are recorded when they are determined to be uncollectible. In this method, in allowance method, it is only an estimation of money that won't be collected and is based on the entire accounts received account. So receivable account. So there are two methods of estimating the bad debts expense: the percentage of sales method um, and the aging of accounts receivable method. Tonight we will just only be discussing about the percentage of sales method. So in percentage of sales method, the percentage of sales method simply takes the total sales for the period and multiplies that number by a percentage. Once again, the percentage is an estimate based on the company's previous ability to collect receivables. So for example, if a company with sales of $2 million estimates that 2% of sales will be uncollectible or will not be collected, their bad debts expense would be $40,000. So how did we arrive with $40,000? Simply we just multiply $2 million to the percentage of the sales that will not be collected, which is 2%. So $2 million multiplied to 2%, it would be $40,000. So another example for percentage of sales method. So example, consider a roofing business that agrees to replace a customer's roof for $10,000 on credit. So the project is completed. However, during the time between the start of the project and its completion, the customer fails to fulfill their financial obligation. So In this first situation, the journal entry would be debit the bad debts expense for $10,000 and credit the accounts receivable for $10,000. The additional information says that um, the original journal entry for the transaction would involve a debit to accounts receivable and a credit to sales revenue. Once the company becomes aware that the customer will be unable to pay any of the $10,000, the change needs to be reflected in the financial statements. Therefore, the business would credit accounts receivable of $10,000 and debit bad debts expense of $10,000. But in this situation, or in this example, additional information, but if the customer is able to pay a partial amount of the balance, which is $5,000, it will be debit cash of $5,000 and debit the bad debts expense of $5,000 and credit accounts receivable for $10,000. So I hope that you understand um, the presentation about the bad debts expense. So the significance of the bad debts expense. So fundamentally, like all accounting principles, bad debts expense allows companies to accurately and completely report their financial position. At some point in time, almost every company will deal with a customer who is unable to pay, and they will need to record a bad debts expense. A significant amount of bad debts expense can change the way potential investors and company executives view the health of the company. So understanding the bad debts expense can help companies assess the effectiveness of their credit policies and identify areas where credit risk is high. So to summarize um, the lesson, bad debts expense is used to reflect receivables that the company will be unable to collect, and bad debt can be reported on financial statements using two methods. So what are these methods? Do you remember? Yes, you're correct. It is the direct write-off method and the allowance method. And the amount of bad debt expense can be estimated using the accounts receivable aging method or the percentage sales method. So for today, we only have discussed the first method, which is the percentage sales method. On our next meeting, we will be discussing about how to estimate the bad debts expense using the aging method. So that's all for today. Thank you, class, for listening, and God bless.